On February 8th, 2026, the global financial system is going to face a reckoning. And it's not coming from where you think. It's not coming from a bank failure in Silicon Valley. It's not coming from a debt ceiling standoff in Washington, D.C. It's coming from the land of the rising sun. Japan is about to make a decision on money printing that is going to impact not just their economy, but the United States dollar, the S&P 500, and the mortgage rate on the house you want to buy. If you are an investor or just someone who likes having money that buys things, you need to pay attention to this because Japan is the largest foreign owner of U.S. government debt. They are the whale in the room. And right now, that whale is bleeding. The Japanese economy has been struggling to keep a lid on a pressure cooker that has been building for 30 years. And on February 8th, they might just decide to blow the lid off. If they are forced to sell those U.S. dollars to save their own currency, that is going to unleash a tsunami of liquidity issues that will flow straight into the U.S. economy. But to understand why a decision in Tokyo matters to a guy in Ohio, you have to understand how we got here. You have to understand that for the last 2 decades, Japan has been running the world's largest economic experiment. They have been the laboratory for modern monetary theory, and the lab is currently on fire. Japan hasn't been dealing with inflation like the rest of us. They've been dealing with the widowmaker. That's what Wall Street calls betting against Japanese government bonds. For 20 years, hedge fund managers have looked at Japan's debt, looked at their aging population, and said, this math doesn't work. They have to crash. So they bet against Japan. And for 20 years, those hedge fund managers have lost their shirts, their Ferraris, and their careers. The Bank of Japan crushed them every single time by printing more money. But this time, the widowmaker trade might actually pay out, and that is terrifying for everyone. To really grasp the magnitude of this, we have to go back in time. We have to go back to the 1980s. If you weren't alive then, or if you were just watching cartoons, you might not realize that Japan was the original economic juggernaut. In the late 80s, Japan was unstoppable. They were buying everything. They bought Rockefeller Center in New York. They bought the Pebble Beach golf course. The corporate raiders of Tokyo were the kings of the world. At the height of the bubble in 1989, the land under the Imperial Palace in Tokyo was reportedly worth more than all the real estate in the entire state of California combined. Think about how stupid that sounds. One palace versus the entire Golden State. That is what a bubble looks like. But bubbles burst. And when Japan's bubble burst in the early 90s, it didn't just pop, it evaporated. The stock market crashed. Real estate values fell by 60, 70, or sometimes 80%, and they stayed down. This ushered in what economists call the lost decades. While the rest of the world was booming in the 90s and 2000s, Japan was stuck in the mud. They entered a deflationary spiral. Now, we all hate inflation because our groceries get expensive, but deflation is the silent killer of economies. When prices fall, you stop spending. Why buy a car today for $30,000 when it might be $28,000 next month? Why build a factory today when the goods you sell will be cheaper next year? So everyone stops spending, everyone stops investing, and the economy freezes. For 30 years, the Japanese government has been trying to thaw it out. They threw everything at it. They built bridges to nowhere just to create jobs. They handed out cash. And when that didn't work, they brought out the bazooka. This is where things get wild. This is where we enter the era of Abenomics, named after the late Prime Minister Shinzo Abe. The plan was simple: print money until the people start spending again. The Bank of Japan turned on the printers, and they didn't just buy government bonds. They bought stocks, they bought ETFs. The Central Bank of Japan became the biggest shareholder in some of the biggest companies in Japan. Imagine if the Federal Reserve owned Apple and Amazon. That is what happened in Japan. They nationalized the stock market to keep it afloat. But the craziest part, the part that makes absolutely zero sense to a rational human being, is the interest rates. They didn't just go to zero. They went negative. Let's talk about negative interest rates, because this is a concept that breaks the brain. In a normal world, if I lend you money, you pay me interest because I am taking a risk. In Japan's world, if I lend you money, I pay you. I give you $1,000, and in a year, you give me back $990. And I say, thank you for your service. Why would anyone do this? Because the alternative was losing even more money elsewhere. The Bank of Japan wanted to force banks to lend. They basically told the commercial banks, if you keep your money sitting here in the vault, we are going to tax you. Go lend it out. They tried to make saving money painful so that people would spend it. It was an act of desperation. And for a long time, the world looked at Japan and laughed. We thought they were crazy. But then the rest of the world started copying them. Europe went negative. The US went to zero. Japan was the trendsetter for bad economic policy. But here's the twist. While Japan was keeping rates at negative numbers to fight deflation, the rest of the world eventually woke up to inflation. In 2022 and 2023, the US Federal Reserve raised rates aggressively. Europe raised rates. Everyone tightened their belts. Everyone except Japan. Japan kept the printers running. Japan kept rates pinned to the floor. And this divergence, this gap between US interest rates at 5% and Japanese interest rates at negative 0.1%, created the greatest infinite money glitch in the history of Wall Street. It is called the yen carry trade. If you want to sound smart at a dinner party, explain the yen carry trade. It's actually very simple. Imagine you have a credit card that charges you 0% interest. And imagine you have a savings account that pays you 5% interest. What do? You max out the credit card, take the cash, put it in the savings account, and you pocket the 5% difference. It is free money. That is exactly what global investors have been doing for years. They borrow yen in Tokyo because it costs almost nothing. They convert that yen into US dollars, and they buy US treasuries or US stocks or Nvidia or Bitcoin. They are using Japan's credit card to pump up assets in America. This trade is massive. We are talking about trillions of dollars. It is the invisible engine that has been pushing asset prices up around the world. Even Warren Buffett, the Oracle of Omaha, got in on this. Look at what he did. He didn't take his billions of US dollars and convert them to yen to buy Japanese trading houses. No, he issued bonds in Japan. He borrowed yen at dirt cheap Japanese rates, used that borrowed money to buy Japanese stocks that pay high dividends, and he pocketed the difference. It's genius, but it only works if the yen stays cheap and Japanese interest rates stay low. And that is where the bomb is ticking, because all that money printing has a cost. The Japanese yen has collapsed. It has lost a massive amount of value against the dollar. If you are a tourist visiting Tokyo, this is great. Sushi is cheap. Hotels are cheap. You feel rich. But if you are a Japanese family trying to buy energy or imported food, you are getting crushed. Japan imports almost all of its energy. They pay for that energy in dollars. So when the yen crashes, their electric bills explode, their grocery bills explode. Japan finally got the inflation it wanted for 30 years, but it got the wrong kind. They wanted demand pull inflation, where people buy things because they are rich. They got cost push inflation, where people are broke because everything is expensive. Now the government is panicked. The prime minister is looking at his approval ratings, and they are in the toilet. The people are angry. They want the inflation to stop. And the only way to stop the inflation is to stop the money and raise interest rates. They have to strengthen the yen. But here is the trap. This is the $12 trillion nightmare. Japan has debt, a lot of debt. They have the highest debt to GDP ratio in the industrialized world. We worry about the US debt being 120% of GDP. Japan is sitting at roughly 250% debt to GDP. They are drowning in debt. When you have that much debt, you cannot afford high interest rates. It is mathematically impossible. If interest rates in Japan rise to even a modest 1% or 2%, the interest payments on their national debt would consume the entire national budget. They would have no money left for pensions, for healthcare, for defense, for infrastructure, nothing. It would all go to paying interest. So they are stuck between a rock and a hard place. If they don't raise rates, the yen collapses, inflation kills the people, and the government falls. If they do raise rates, the government goes bankrupt and the economy collapses. It is a choose-your-own-adventure book where every ending is a disaster. And this brings us to February 8th. The Bank of Japan has to make a move. They have been teasing a pivot. They have been tweaking their yield curve control policy which is a fancy way of saying price fixing the bond market. But the market is sniffing out blood. The widowmaker traders are back. They smell that the Bank of Japan is out of ammo. They are betting that Japan will be forced to raise rates whether they want to or not. And if that happens, if Japan raises rates, the yen carry trade unwinds. Remember that free money glitch? It stops working. If borrowing yen suddenly costs money and the yen gets stronger, making it more expensive to pay back the loan, the math breaks. Investors have to sell their U.S. assets to pay back their yen loans. They have to sell their U.S. stocks. They have to sell their U.S. treasuries. We saw a preview of this in August 2024. Japan raised rates by a tiny amount, just 0.25%, and the global markets panicked. The Nikkei crashed 12% in one day. The U.S. markets took a nosedive. That was just a tremor. The earthquake is still coming. And there is another layer to this horror story, the Japanese housing market. In the United States, we love our 3-0-year fixed rate mortgages. You lock in a rate, and if inflation goes up, you don't care. Your payment stays the same. In Japan, almost nobody has a fixed rate mortgage. About 79% of Japanese homeowners have variable rate mortgages. They call them floating rate loans. Why? Because for 30 years, the rates have been zero. Why lock in a rate when the floating rate is basically free? It seemed like a smart bet. Until now, if the Bank of Japan raises rates to fight inflation, mortgage payments for millions of Japanese families will shoot up. We are talking about a population that hasn't seen a rate hike in their adult lives. Their wages haven't gone up in decades. They have no buffer. If their mortgage payment doubles, they default. It's that simple. You could see a wave of foreclosures that would make 2008 look like a picnic. This would shatter the Japanese banking system, which is holding all these loans. And in the globalized world, when the third largest economy's banking system shatters, everyone gets cut by the glass. So why does this matter to the U.S. bond market specifically? Because Japan is the largest creditor to the United States. They own about $1.2 trillion of our debt. When the U.S. government spends money it doesn't have, which it always does, it issues treasury bonds. Japan buys a lot of them. If Japan is in trouble, if they need to prop up the yen or rescue their banks, they need cash. Where is their cash stored? It's stored in U.S. treasuries. They will have to sell. If the biggest buyer of U.S. debt turns into a seller, what happens to the price of U.S. bonds? It crashes. And when bond prices crash, yields interest rates go up. This means the U.S. government has to pay more to borrow. It means U.S. mortgage rates go up. It means credit card rates go up. It means auto loans go up. A crisis in Tokyo translates directly into higher monthly payments for a family in Texas. It is the butterfly effect, but instead of a butterfly, it's Godzilla stomping on a printing press. And we haven't even talked about the demographic time bomb. Japan is dying, literally. Their population is shrinking by nearly 1 million people a year. They sell more adult diapers than baby diapers. Think about the economics of that. A shrinking workforce has to support a growing population of retirees. The debt burden per worker is skyrocketing. There is no way to grow your way out of debt when your population is shrinking. The only option is to print money or default. And history tells us that governments always choose the printer. They will print until the currency is worthless rather than admit they are bankrupt. So, what is the end game here? What happens on decision day? The Bank of Japan is likely to try a soft landing. They will try to raise rates just enough to stop the yen from crashing, but not enough to bankrupt the government. They will try to talk tough while acting weak, but the market isn't stupid. The market knows they are trapped. Eventually, the dam will break. The yield curve control will fail. Rates in Japan will spike. The yen will violently appreciate as the carry trade unwinds, causing a massive sell-off in global assets. Then, the Japanese economy will seize up due to the debt burden, forcing the central bank to pivot back to hyperprinting. It is a cycle of doom. And for the United States, it means the era of cheap foreign capital is over. For decades, we have relied on Japan and China to buy our debt and keep our interest rates low. China has already stopped buying. Now Japan is leaving the room. That means the U.S. Federal Reserve will eventually have to be the buyer of last resort. They will have to restart QE, quantitative easing. They will have to print dollars to buy the debt that Japan is selling. And that means inflation in the U.S. is not dead, it's just taking a nap. So what does this mean for you? If you were sitting there thinking, this sounds like a disaster, I should just put my money under the mattress, you are wrong. Cash is the worst place to be when the printing presses are running hot. If Japan breaks, the response from global central banks will be coordinated liquidity injections. They will print money to save the system. That debases the currency. This shift creates winners and losers. The losers are the NPCs holding cash and long-term bonds. The winners are the main characters who own real assets. This is why you see gold hitting all-time highs. Gold is sniffing out the insolvency of the sovereign debt market. Central banks are buying gold because they know their own paper is getting risky. If the Bank of Japan can fall, anyone can fall. But there is also a fascinating opportunity inside Japan itself. Remember how I mentioned Warren Buffett? He sees something. For decades, Japanese companies were run for stakeholders, employees, suppliers, the community. They didn't care about the stock price. They hoarded cash. They were inefficient. But that is changing. The Tokyo Stock Exchange is forcing companies to care about shareholders. They are shaming companies that trade below their book value. They are pushing for buybacks and dividends. Japan is shifting from a stakeholder system to a shareholder system, similar to the US. This corporate governance reform is unlocking value. Japanese stocks are cheap compared to US stocks. So while the macroeconomy of Japan is a horror show, the microeconomy of specific Japanese companies is actually becoming more attractive. It's a paradox. The country is broke, but the companies are rich. So how do you navigate this? First, you stop looking at the world through a domestic lens. You cannot understand the US stock market without understanding the Japanese bond market. They are tethered together. Second, you look at your portfolio. Are you overexposed to assets that rely on cheap liquidity because liquidity is drying up? Third, you consider the anti-fragile assets, gold, Bitcoin, commodities, things that cannot be printed by a central banker in a panic. The decision on February 8th is just one marker in a long timeline of decline for the fiat experiment. Japan is the canary in the coal mine because it started the money printing experiment first. They hit the demographic wall first. They hit the debt wall first. What happens to Japan in the next 24 months is a preview of what will happen to Europe and the United States in the next decade. We are all on the same train. Japan is just in the front car, and that front car is looking over the edge of a cliff. Don't let the technical jargon fool you. Yield curve control, carry trade, variable rate mortgages, these are just fancy words for we borrowed too much money and now the bill is due. The bill is coming due on February 8th. The bill's coming due for the yen. And eventually, the bill comes due for everyone. The smart money is already positioning for this. They are shorting the bonds, longing the commodities, and buying the high-quality companies that can survive the inflation. The dumb money is ignoring it, hoping that the government has a plan. The government does not have a plan. The government has a printer, and when all you have is a hammer, everything looks like a nail. They are going to hammer the currency to save the debt. So watch Tokyo, watch the yen, watch the yields, because the butterfly that flaps its wings in Japan is about to cause a hurricane on Wall Street. And you want to be the one selling umbrellas when the storm hits, not the one getting washed away. This is the financial reality of 2026. The easy mode is over. Welcome to the hard mode. Make sure you are prepared. Make sure you are diversified. And make sure you are paying attention, because the widowmaker is coming for everyone's portfolio, and only the prepared will survive. Now, if the debt bomb and the currency collapse weren't enough to make you want to hide under your bed, let's talk about the one problem that no amount of money printing can fix. You can print yen. You can print dollars. You can print euros. But you cannot print people. And this is where Japan's story turns from a financial thriller into a demographic horror movie. Japan is literally dying. I don't mean dying in a metaphorical sense. I mean, the population is shrinking by nearly 800,000 people every single year. That is like a city the size of San Francisco disappearing from the map annually. Poof, gone. For the first time in history, Japan is selling more adult diapers than baby diapers. Think about the economics of that sentence for a second. A baby represents future growth, future consumption, and future taxes. An adult diaper represents, well, Let's just say it represents the end of the economic cycle. This matters because of a little concept called the dependency ratio. In a healthy economy, you have a pyramid. You have a huge base of young workers at the bottom, paying taxes, buying houses, and funding the pensions of the retirees at the top. It works because there are 10 workers for every one retiree. But Japan has inverted the pyramid. They have a massive top-heavy layer of retirees living longer than ever before, and a shrinking sliver of young people at the bottom trying to hold the whole thing up. It is a mathematical impossibility. These young people are being asked to pay 250% of the national debt, fund the health care for the elderly, and somehow save for their own future, all while wages have been stagnant for 30 years. Is it any wonder they aren't having kids? Who can afford a kid when you are carrying the financial weight of an entire geriatrics ward on your back? It is a vicious cycle. The debt requires higher taxes. Higher taxes mean young people have less money. Less money means fewer babies. Fewer babies mean fewer future taxpayers. And fewer taxpayers mean the debt burden per person gets even heavier. It is a death spiral. The Japanese government knows this. They aren't stupid. So what is their solution? Robots. I'm serious. Their plan is to automate everything. They want robots to take care of the elderly. They want robots to serve your sushi. They want robots to drive the taxis. And while that sounds cool and futuristic like Cyberpunk 2077, there is one major flaw in the plan. Robots don't pay income tax. Robots don't buy houses. Robots don't consume consumer goods. An economy is driven by consumption. If you replace consumers with machines, who buys the product? Who pays the interest on the debt? This demographic collapse is the ultimate rug pull for the pension system. The Japanese pension system, like Social Security in the US, is basically a legal Ponzi scheme. It relies on new investors, young workers, paying off the old investors. When the flow of new investors dries up, the scheme collapses. Japan is reaching the point where the scheme breaks. And when it breaks, the government will have only one choice: print the difference. They will have to print yen to pay the pensions. And as we discussed, printing yen causes inflation. So the retirees will get their check, but the check won't buy anything. It is a soft default. They are fulfilling the promise on paper, but breaking it in reality. And here's the scary part for everyone watching in Europe or America. Japan is just a time machine. They are about 10 to 15 years ahead of us. Look at the birth rates in Italy. Look at Germany. Look at China. China is actually aging faster than Japan did. Look at the United States. We are all following the same path. Japan is the canary in the coal mine, but the canary is already dead, and we are just staring at it, wondering why it's not singing. This demographic reality is why the interest rate decision on February 8th is so critical. A country with a shrinking, aging population cannot handle high interest rates. It is physically impossible. When your workforce is shrinking, your GDP growth naturally slows down. You cannot have 5% interest rates in an economy that is growing at 0.5%. It bankrupts everyone. So the Bank of Japan is trapped by biology. They are fighting against nature itself. This is why the widowmaker trade has been so dangerous. Traders look at the debt and say, short Japan, but the Bank of Japan looks at the demographics and says, we must print forever because there is no organic growth left. It is a battle between mathematical solvency and existential survival. And usually when a government fights for survival, it will sacrifice the currency to do it. They will destroy the yen to save the system. So when you see those headlines about Japan's labor shortage, don't just think about help wanted signs at a convenience store. Think about the collapse of the tax base. Think about the insolvency of the pension funds. Think about the fact that the largest holder of U.S. debt is a country that is slowly going extinct. If they need cash to pay for their aging population, they aren't going to ask nicely. They are going to sell their assets. And their biggest asset is the United States Treasury market. The demographic time bomb in Tokyo is wired directly to the mortgage market in Texas. So we have established that the ship is sinking. The debt is too high. The currency is being debased. The population is shrinking. And the central bank is trapped. It is a grim picture. If you are acting like an NPC, a non-player character, you are just sitting there waiting for the developers to patch the game. But the developers, the politicians and central bankers, are the ones who broke the game in the first place. They are not coming to save you. So how do you become the main character? How do you survive the great reset of the financial system? You have to understand one simple concept: capital flight. When a currency dies, money doesn't just disappear. It moves, it flees, it runs away from the burning building and tries to find a fireproof safe. Right now, we are witnessing the early stages of a massive global capital flight. Money is running away from long-term government bonds. It is running away from fiat currencies that are being inflated away. And it is trying to squeeze into hard assets. Think of the global financial system like a game of musical chairs. But instead of chairs, there are assets like gold, silver, Bitcoin, prime real estate, and profitable companies. And instead of kids playing the game, it's trillions of dollars of liquidity. When the music stops, and the music is stopping in Japan right now, there are not enough chairs for everyone. The people holding yen, euros, or dollars are going to be left standing without a chair. The people holding the hard assets are going to be the ones naming their price. Let's talk about the anti-fragile portfolio. This isn't financial advice. This is financial survivalism. The first lifeboat is gold. I know. It's a boomer rock. You can't eat it. It just sits there. But look at who is buying it. The Central Bank of China, the Central Bank of Russia, Poland, India, even Japan. They are buying gold at record paces. Why? Because gold is the only asset that is not someone else's liability. If you own a treasury bond, you are relying on the government to pay you. If you own gold, you own an element on the periodic table. It doesn't need a promise. It just is. In a world of broken promises, the asset that requires no trust is king. Then there is Bitcoin. You can hate it. You can call it a scam. You can say it's rat poison squared. But you cannot ignore the fact that it is the only asset in human history with a mathematically fixed supply that cannot be diluted by a politician. When the Bank of Japan prints 1 trillion yen, the supply of yen goes up. When the Fed prints $1 trillion, the supply of dollars goes up. The supply of Bitcoin stays the same. It is the digital equivalent of a fire exit in a crowded theater. When the yen collapses, you will see a flood of capital moving into crypto, not because they love the tech, but because they need a lifeboat that the government can't confiscate or debase. But here is the plot twist. Here is the opportunity that the smartest investors like Warren Buffett are looking at. It's inside Japan itself. Remember how I said Japan is a disaster? Well, the government is a disaster. The currency is a disaster. But the companies, some of them are actually incredible. For decades, Japanese corporate culture was conservative. They hoarded cash. They didn't borrow money. They have balance sheets that are fortress-like. While American companies were leveraging up to buy back their own stock, Japanese companies were stuffing cash under the mattress. Now, with inflation arriving, that cash is being deployed. The Tokyo Stock Exchange is forcing these companies to wake up. They are saying, hey, stop acting like a savings bank and start acting like a business. This is why Buffett borrowed yen to buy the 5 major Japanese trading houses. He saw the disconnect. He saw that he could borrow money for free thanks to the Bank of Japan and buy assets that produce real cash flow, real commodities, and real energy. He is shorting the currency and longing the productive economy. That is the main character move. He isn't sitting in cash. He is using the broken system to acquire real things. So, what is the lesson for you? It is simple. Do not hold the bag. The bag is fiat currency. The bag is long-term government debt that pays you less than the rate of inflation. You need to pivot. You need to own things that scarcity protects. If you are renting, you are short on real estate. If you are holding cash, you are short on inflation. You need to flip the script. Own the house with a fixed rate debt, if possible. Let inflation pay off your mortgage for you. Own the commodities. Own the businesses that have pricing power, meaning when their costs go up, they can raise prices and customers still pay. Coca-Cola has pricing power. A generic consulting firm does not. The event on February 8th is a warning shot. It is the universe telling you that the era of easy money is over and the era of hard choices has begun. The volatility is going to be extreme. We will see days where the market crashes 10% and days where it rallies 10%. The NPCs will panic sell at the bottom and panic buy at the top. They will get chopped up. The main characters will sit still. They will look at their gold, their Bitcoin, their real estate, and their cash flowing stocks. And they will sleep soundly because they know that while the currency might die, value never does. Value just changes form. We are watching the greatest wealth transfer in history. Wealth is moving from the impatient to the patient, from the paper holders to the asset holders, from the blind to the awake. You have the information now. You see the train wreck coming. The question is, are you going to stand on the tracks and argue about whose fault it is? Or are you going to step aside and watch it happen from the safety of high ground? The choice is yours. But the clock is ticking. February 8th is coming. Japan is moving. The yen is shaking. And the global financial system is holding its breath. Don't be the one left holding the bag when the exhale comes.